Hello and welcome to you wherever you are in the world. This webinar is now live. Today's discussion is entitled Looking Towards 2021, Regulation, Rules and Responsibility. And my name is Nick Pratt, Technology and Operations Editor at Funds Europe. The aim today is to provide a comprehensive review of this year's regulatory environment, to forecast what can be expected in 2021, and to tell market participants how to prepare. In the course of our 45-minute discussion, we will also identify the gaps in compliance that came up in the last year and how these can be addressed in the next 12 months. So firstly, let me introduce our panelists for today. Ken Owens, partner in the Asset and Wealth Management Regulatory Advisory Group at PwC Ireland.
There's a unified enforcement agenda behind how some of that works. So a very busy period for regulation, and also.
And we will try to answer Asset Management Infrastructure Platform, Technology and Operations Editor at Funds Europe. The aim today is to provide a comprehensive review of this year's regulatory environment, to forecast what can be expected in 2021, and to tell market participants how to prepare. In the course of our 45-minute discussion, we will also identify the gaps in compliance that came up in the last year and how these can be addressed in the next 12 months. So firstly, let me introduce our panelists for today. Ken Owens, partner in the Asset and Wealth Management Regulatory Advisory Group at PwC Ireland. Owen Motherway, Ireland Country Head and Executive Director at Asset Management Infrastructure Platform, AMX. And Rolfine Kuipers, Chief ESG Client Officer and Head of the UK, Nordics and Ireland at Asset Manager DWS. So in order to make this as comprehensive as possible, we have divided the discussion in the initial period into 3 areas based on the expertise of our panelists. Rolfine will look at behavioural and organisational change as a result of sustainable finance and ESG initiatives and rules. Ken will look at disclosure and reporting through the prism of IFR, AIFMD and MiFID II. And Owen will look at substance, delegation and risk management as seen in the SNCR, European Consultation and CP86. And as the discussion goes on, I'm sure we'll see how these areas are converging. And just before we start, I should add that viewers are encouraged to send in questions at any time, and we will try to answer those, as many of those, in the time that we have. So my first question to all the panelists is, where did rules and regulation have the greatest impact for you in 2020, and what took up most of your time and attention? So Rolfine, if we can start with you.
Yes, thank you very much, and welcome everyone to today's webinar. 2020 clearly is a year of many firsts. We all had to deal with COVID-19, and although there's light at the end of the tunnel, that's not over yet. And we all had to work. I work in the UK. We have been working since the middle of March from home, and most of DWS globally has been working from home as well. And I'm sure a lot of you have been working from home. So many firsts in this year. But as the ESG client officer, I also would like to say that this year has been a true year of ESG investing. We have seen, despite COVID-19, I was very concerned at the beginning of this year that this would potentially move the whole focus on ESG, which had gathered so much momentum over the last couple of years. I was worried that this could be moved to the sidelines. But if anything, it turned out to be the year for ESG investing, and particularly for climate investing. DWS itself, at our AGM back in November, we committed to climate neutrality, and last Friday we became a signatory to the first group of asset managers that formed the Net Zero Asset Manager Coalition, and that was rolled out just before this last weekend's Climate Ambition Summit, which was hosted by the UK Prime Minister. So not only DWS has made this climate neutrality statement, but also others in business, and clearly currently half of the world's GDP is committed to net zero emissions. And when the US re-enters the Paris Agreement on January 20th with President-elect Biden becoming president, that means that at that point, 2/3 of the world GDP has committed to net zero commitments. So incredible momentum throughout 2020 when it comes to climate and ESG investing. In answer to your question, Nick, with regards to what have we been focused on as a fund manager, we've really been focused on getting ready for the EU Action Plan on Sustainable Finance. As you all may know, by March, a classification will go into place of Article 6, 8 and 9 funds, a new classification on sustainable funds. So we've been very focused on making sure that our funds fit the EU taxonomy and other regulatory requirements as well. Not only have we gotten ready to make sure that our funds are classified in these 3 different articles, but it also meant that we had to educate our sales teams across Europe. We also worked with a lot of our distribution partners to ensure that they were educated on what that fund classification methodology means for them and what it means for the DWS funds. And of course, we've also had to educate our clients on that as well. Now, none of this came as a new surprise for DWS. We've been working on this for the last 5 or 6 years, but it's been a busy year from an ESG point of view and fulfilling ESG requirements. But I will very much say that DWS is ready, set, go for next year.
Great. Yeah, thanks, Rolfine. And Ken, what would have been the priorities for you this year?
Oh, good day, everybody. Thanks, Nick. Well, I suppose my year has been kind of bookended by Brexit. In my role in PwC, I spend a lot of time working with clients and have been on Brexit-related projects, and I'm also involved with the Industry Association here in Ireland on Brexit. I chair their Brexit steering group, so my year's been kind of bookended by Brexit. So at the start of the year, I suppose we were relieved that the transition period, we managed to get into a withdrawal agreement and a transition period, and then I suppose everybody just parked Brexit. One of the things that had happened that the regulator had implemented in Ireland from a Brexit perspective was that they implemented liquidity reporting. And as we moved into 2020, certainly liquidity risk, liquidity reporting became a much more significant issue. It became an issue in 2019 for a number of well-publicized reasons, and then we had the ESMA guideline about liquidity risk reporting. So I think liquidity and thinking about liquidity was on everybody's mind, and then COVID and the market turbulence of March hit. And I suppose what happened there was certainly an insatiable appetite by regulators for data around liquidity. And I think certainly in Ireland, we saw that the bank leveraged heavily on the liquidity reporting that they were already getting. And certainly liquidity and liquidity risk and liquidity stress testing has become almost a weekly discussion point now with clients, leading up to the requirement for liquidity reporting, for liquidity stress testing frameworks for firms. I suppose kind of moving away from that, the one regulation or new regulation that we've been focused on and trying to raise awareness with our clients has been IFR and IFD, the new prudential regime for investment firms. It's going to be a new capital framework for investment firms that's designed specifically for the sector. So all but the biggest firms will have to stay and continue to comply with the capital requirements that apply to banks. But from an investment firm perspective, we now have a new regime. So again, there's kind of 2 elements to that. One is there's a lot of data, new data requirements for that. And secondly, reporting is a significant element for that. And certainly in talking to our clients who have done some initial gap analysis, there's a significant uplift in the amount of reporting that they have to do, and therefore the amount of data that they have to collect. Linking into what Rolfine has just talked about in terms of ESG, I suppose IFR and IFD is a kind of like every other piece of EU regulation going forward, there is an element of ESG compliance in it. So firms will have to disclose data and information about their ESG risks, both physical and transition, as part of the disclosure that they have to make under IFD and IFR. So that's something. And then I think finally the last point is around resilience. I think we've seen firms having to move from business continuity to resilience plans, from kind of having the plan to implementing the plan. And I suppose it's a testament to the planning and the resilience of our industry that happened quite seamlessly over the period. I think there will be more focus on that to come, but I think that this has been the biggest test of resilience pre-planning that we could have ever have dreamt of, and I think we've fared quite well.
Great, thanks, Ken. So Owen, just to round off our review of 2020.
Sure, and I guess I would pick up one minor point from Rolfine and Ken. Firstly, Rolfine is absolutely correct in that the surge in focus on ESG and research on ESG and should we be in ESG has been very prevalent across the client base and different prospects we talk to. I think equally it's had a new impetus on a very personal level for all of us, because we're now looking at what working from home does and the impact that's had on the green agenda and all of that kind of thing. So from the end investor perspective all the way through to the institutional investment being made on their behalf, I think there are new anchor points in ESG that completely tally with what Rolfine is alluding to. On COVID-19, I think Ken is right, the industry has been very resilient. I think there's probably two areas of focus that we have seen and spent a lot of time on. The first is that, as an asset management firm and as an infrastructural platform, everything that we have is very dependent on our service provision and our delegates, right? And a number of them would have had various outsourcing work practices in place with their colleagues around the globe. And in many instances, that work was re-onshored or near-shored and taken out of some of the other countries. So from a BAU perspective, we've been very focused on, is it all working? Does everything work? And are there any delays? Because we have to make sure that the engine keeps running and our investors get their requirements. Secondly, from a board perspective, I think we've been very focused on, was that sustainable, and is it still sustainable, and indeed is it being unwound back into its point of origin? And the Central Bank of Ireland has also been quite vocal that they're monitoring that component, as I'm sure other regulators around the globe are, to see that we get back to some form of normal routine, even if that still is work from home. The other two things that have really filled our time have really come in the last quarter, right? Firstly, there's the Dear Chair letter that came out in Ireland as the thematic inspection of CP86. That's been ongoing since July last year. And in the first time in my memory, the regulator issued a questionnaire that was empirical in nature. So it gathered numbers and data and dropped down boxes so it could be analysed and extrapolated, as opposed to prior engagements with the regulator, which were all verbal or written, and somebody had to assimilate all the tomes of responses into something sensible. Followed by desktop reviews and on-site inspections, which were concluded virtually. The letter that came out on October 20th is quite telling, is quite exacting, and quite scathing in parts. So the reaction of various firms to that and how we engage with that has been a big thing for us. I think there's been a spectrum of reactions from blue disappointment to white fury, and where you are on that spectrum has been driven really on how closely you paid attention to the clarifications that were percolating out over various speeches and regulator events. And then lastly, I think recently we've just had a Dear CEO letter on fitness and probity, which I think also has some censure in it and items that will be worked through. And there's 4 pillars to that. There's a conduct standards, there are F&P enhancements, there's the SEER regime to come next year in Ireland, which will mirror the SMCR in the UK and the BEAR system in Australia and others. And then there's a unified enforcement agenda behind how some of that works. So a very busy period for regulation, and also, as Rolfine would have opened with, a very busy period of asks from clients and investors, and we're trying to meet somewhere in the middle.
Great, thanks, Owen. So, I mean, it sounds like it's been a busy end to the year, and it could possibly be a very busy beginning to next year. So, I wanted to ask next what the regulatory priorities will be for 2021, and are there any specific deadlines to look out for? And Rolfine, you mentioned the EU Action Plan for Sustainable Finance. So, are there any specific dates that you're working towards, and when might those be?
Yeah, thank you. Yes, we are working to what I mentioned earlier, the implementation of the Article 6, 8 and 9 funds, which are due in March. So I think we're pretty much ready at the moment for full implementation of that. So as I said earlier, we've been working on this for a number of years. But there has been some pushback from some other fund managers who are not necessarily ready, I believe, who've been pushing back on that date. We're taking the view that that date will not be pushed back on. So again, we're ready for implementation come March. I also like to pick up on two other points that my fellow panelists have made. One is Brexit, and of course, as a fund manager with a large business in the UK as well, we've been very focused around being ready for Brexit as well, and to Ken's point, that's also taken up a lot of our time during the year. And to Owen's point, he mentioned the word resilience. I think Ken mentioned it as well. Yes, the industry has proven to be very resilient over the last year, and clearly we have to continue to motivate our people, everyone that we work with, our clients, to continue with that resilience, because even though there is light at the end of the COVID tunnel, it still will be most likely a working from home type environment for at least the foreseeable future. I also, on the regulatory front, particularly when it comes to ESG and ESG data, I thought it was interesting that the Dutch and the French regulator have recently come out and are asking for introducing a European-wide regulatory framework related to providers of sustainability type data. And I actually think that's a very positive development. And at DWS, we're very much in favor of more harmonization of that data and of sustainability service providers across the European Union. So we very much welcome this joint approach of the Dutch and French regulators, because ultimately for investors, it will ultimately more mean, on one hand, increased transparency, which I think is really important, to also ensure that the industry doesn't fall foul of greenwashing. So more transparency is definitely a positive point, but it also, I think, will lead to a lower cost of those type of sustainability services over time, and that will ultimately benefit the end investors. So I thought I would mention it because it's a very recent initiative, and I very much hope that this greater harmonization will indeed be coming through in 2021.
Sure. I mean, it's a great point, and one that I'm sure we'll return to in this discussion, particularly when we get on to cost and who ultimately bears that cost. Ken, and for you, are there, I presume, a string of deadlines that you're facing or your clients are facing?
Yeah, a plethora, but I'll highlight a couple of priority areas that I think is certainly we're focusing on, and we suggest our clients focus on. I won't go into the ESG stuff that Rolfine has already spoken about, the SFDR deadline. I suppose the first one is the F&D review. So the consultation questionnaire is online at the moment and is open until the end of January. And I think certainly at the moment that's a very high priority on our list and amongst a number of our clients and certainly the industry associations. I mean, this could shape the industry for the next 5 to 10 years. So I think, a robust, data-driven or evidence-backed response to that is what's being called for by the Commission. And I think it's very important that the industry engages with that. I I think secondly, there will be more work on liquidity. Certainly in a recent event that we did with a representative from the central bank, they said there will be more on liquidity. And I think certainly we can expect, and firms can expect, more engagement from regulators on the framework, on the liquidity stress testing frameworks that they've put in place, and on the reporting around liquidity that they're providing now to regulators. I think linked to that, and back to the AFMD point, is certainly the regulators, I think, are looking and will look for more data. I think what they learned through COVID is that in some areas they didn't have enough data to understand where the risks were. And I suppose it's looking beyond the risk at an individual fund level now and looking at the macro-prudential exposure which the industry creates. And that's a term that we're hearing more from regulators now, that it's not looking at an individual fund, it's looking at the entire sector and looking at the positions and the exposures in the entire sector. And in AFMD review, for instance, one of the things that they're talking about is extending the Annex 4 reporting and extending that reporting to UCITS funds as well. So if that were to pass, that would be a very significant point. And then thirdly, around supervisory convergence, we will see more coordinated activity from the regulators. That's no doubt about that. The one that I'd point to as being something that has been flagged again to us as being a priority area is the focus on costs and fees, and the fact that ESMA has issued a letter to the supervisory authorities about there being a what they call a coordinated supervisory activity, a CSA, in 2021 on this particular topic. And I think that has the potential to be a significant exercise and potentially a challenge for some players if they look for, lots and lots of data to back up the costs and charges that are being levied on funds.
Sure. So I suppose it's super a focus on asset managers' costs and fees rather than the cost of compliance that the regulators are focusing on.
It's the cost that the end investor pays.
Yeah. Yeah. So Owen, and for you as well, what are the deadlines? I presume it's going to be quite a busy January and March, possibly.
Yeah, and before I get to that, I think Ken is right on the cost and fees component. I think the other one I'd throw in there that is often forgotten is the performance fee that investors pay, right? And there's quite a lot of thought and various thought pieces coming out on that too. And I think that will also make its way into legislation of how you do it. And equally, you have the cost transparency initiative in the UK that's also trying to flush out greater transparency to the end cost for investors, which we would all welcome, right? I think in terms of some of the deadlines that we see popping up, Ken has alluded to the EC consultation. I wholeheartedly agree with him. It's going to shape the industry for the next 10 years, right? And while it is being labelled as a review of AIFMD, whatever comes out of it will absolutely be applied to UCITS in due course. So I don't think if you're a UCITS manager, you can choose to just simply ignore this consultation because it will impact you at some point. Therefore, if you have something to voice, either do that through your own submission or through one of your industry representative bodies. So I think that's due in by the 31st of January. I think ironically, the plan response from your board to CP86 in Ireland is due in the 31st of March after the consultation period closes, even though the consultation document only arrived out 2 days after the Dear Chair letter. So for many firms that would actually make wholesome contribution to the consultation, they actually have a lot of work on already in terms of their Dear Chair plan that has to be finalised. And if you reverse re-engineer the timeline, if it is to be approved by the end of March, then reality is the board pack needs to be ready by the middle of March, which means the plan has to be planned by the middle of February. So all the reconnaissance on all of the options you may wish to choose from in order to get to your plan needs to be done between now and mid-February, which is a really tight timeline. Having said that, once the plan is in place, there is no deadline on the implementation, but the expectation would be that you would do it within 12 months, excuse me, of that date. The other thing I think that's coming for us in Ireland, certainly next year, is the SEER regime. And in some ways, it's an extension of what's going on in the EC consultation and CP86, because it's bringing governance and the accountability for governance down to the individual. So far, all of the consultations, the expectation of substance and so forth has been about the firm or the legal entity, whereas SMCR, BEAR, SEER is all about the individual officers conducting the roles, and that will bring a whole new degree of atonement, or to walk away from scenarios which you feel are being inappropriately managed or governed. So I think the advent of SEER in Ireland is going to be an interesting one to see how that is also reacted to.
Great. I mean, obviously, Owen, you mentioned that there is a lot at the beginning of the year, so it's a pretty sort of tight schedule. So are there any headwinds that you see that could upset people's plans, or particularly big challenges that people should prepare for in terms of their regulatory work?
I think there's probably two. One is for service firms and one is probably for managers themselves. The first is resourcing, right? Yeah. So regardless of what comes out of the EC consultation will probably take a year or more to play out. Okay, there's already exacting expectation of 3FT in the Beer Chair. There's already 3FT in Luxembourg with 18698, and there have been similar reviews of the ACD market in the UK. All of them are looking for competent, seasoned resource that have authority and experience to ask the right questions. Also, all but the smallest of management companies now are expected to have a CEO. That person can't be junior either. So there is going to be a big constriction, I think, on resourcing, notably in compliance and risk functions, and then equally in the senior CEO type piece of it. In terms of the manager headwind, I do think sustainable finance is an issue, particularly with the UK choosing to have its own sustainable finance regime. Right, and if you like, this is one of the first consequences of Brexit, with the UK lamentably leaving the European Union. So if you have two regimes, what does that do to the manager who's based in the UK and is distributing in the UK and in Europe? They have to comply with two regimes. Similarly, a European manager or a US manager distributing in Europe and the UK will have to comply with two regimes. And who's going to bear the cost of that? Ultimately, it has to either impact the fund or the investor if the manager can't eat it out of their own fees. So I think there's a bit to play out there. Equally, if one regime is more burdensome than the other, and they won't be perfectly aligned, then arguably a manager will exact one regime. So let's use a simple example. Let's say the European regime is more exacting than the UK one. The manager will adhere to and report in line with the European regime, and then they choose to put in a footnote saying everything in the UK requirements is covered here, which will only undermine the UK regime ultimately, and that could play out vice versa also. So I think there's a fair bit to play out there in terms of headwinds.
Sure. So we could see a whole new era of regulatory arbitrage based on these sort of differences in this divergence.
I think so, and it will also play out in the distribution market, right? So UK managers looking to distribute into Europe and so forth, that's also going to play out as well.
Sure. And so just before we get on, Ken, to something that's a question from the audience that's quite Ireland specific. Rolfing, just on the issue that Owen mentioned about the divergence on taxonomy. So I guess from the ESG perspective, how do you prepare for two possible regimes when you're not quite sure what those regimes will look like?
Yeah, thank you. And it's a very good point that Owen made around the potential divergence between a UK taxonomy and EU taxonomy, UK regulations in ESG land versus EU regulations. So that will definitely create more complexity. But as a global asset manager, DWS already works in many different markets around the world. So the regulation in the US, if we look at the Department of Labor or the SEC guidance under the Trump administration versus the Obama administration was very different. And we expect the Biden administration to be much more in favor, again, of ESG investing. And they will have their own framework. And that may be different from the EU framework, and that may be different from the UK framework. And similarly, if we look in Asia, for example, the Japanese framework is different from the Chinese framework, which is different from the Australian framework, and so forth. So as a global asset manager, we're very attuned to working across different regulatory regimes. You know, clearly we are governed by many different regulators around the world. So this is sort of our bread and butter business. We do know how to operate in different regulatory regimes. But of course, with Brexit and the UK leaving the EU, that just creates, to Owen's point, a lot of complications for those UK-based asset managers who distribute in the EU, and for EU-based asset managers distributing in the UK. And ultimately, I do hope that the ultimate cost to the investors in underlying funds will not be impacted by any of these regulatory changes that will be taking place. The UK made it very clear it wants to have its own taxonomy, it wants to have its own regulatory playing field in place, and that is clearly it's clearly going to add to the complexity that asset managers across the UK and EU will have to ultimately deal with.
Sure. I want to explore the cost question in just a little bit, but before that, we do have a question from the audience that perhaps, Ken, you want to start with, because it's quite Irish specific, I guess. But does the panel think we've seen the end of SMICs? And I guess this is inspired by CP86 and the potential cost and resourcing interest that you touched on.
Yeah. So SMIC, SMICs, self-managed investment companies. But I think we've already seen the end of them. Certainly, if you look at the data and the market activity that's been happening, certainly in the Irish market since about 2017, it follows what happened in the Lux market a number of years previous to that. So there's virtually no new self-managed investment companies being set up. And I suppose it plays into, my own perspective now that, there's an awful lot more focus and emphasis being put on the role of the ManCo, the management company, by the regulatory authorities across the EU. That is only going to increase. Certainly in Ireland and Luxembourg are in the spotlight. An article this week in the media about this from a regulatory authority, on this point. But more generally, if you look at things like the Sustainable Finance Disclosure Regulation or Shareholder Rights Directive, the ManCo is the entity that is front and center from a compliance perspective in terms of those regulations. It's the ManCo that has to comply or make sure that the funds comply. And all that plays into having more substance, which plays into more cost, which means that having a self-managed fund, which, is just not sustainable from an operational perspective, notwithstanding that it is, still permissible from a regulatory perspective, albeit that the bar has now gone up.
And without wanting to be too parochial, do you think that's ultimately a good thing for Ireland as a fund domicile if there are fewer or no SMICs and a more ManCo-led?
No, well, again, it depends on your perspective. I suppose, what the self-managed investment company did was it gave a very cost-effective mechanism for, particularly non-EU investment firms to establish a foothold in the EU and to offer their products in the EU market. That obviously, increased competition. It provided access to strategies and to managers that wouldn't otherwise be available to EU investors. Which if that route is not available, then that's a problem. Now, having said that, I suppose the industry is very innovative. So as the self-managed structure has become more challenged, what you're now seeing is more platform businesses or infrastructure businesses being set up to provide the same access under a managed or third-party management company solution. And we're seeing certainly an explosion of interest and growth in those platforms as a means of giving that access to the EU market and EU investors that the self-managed structure previously provided.
I think it's worth pointing out that it sometimes gets lost in the coverage that there's nothing wrong with running a SMIC. It hasn't been outlawed. There's nothing wrong in using that form of entity structure. But the expectation of how you run it and how you govern it has now gone up, and therefore the cost of it is now going up. And it is a case of, can you wear the cost of putting in your own team, or do you go for arguably a more economic option of a third-party management company or a platform, a full infrastructure or platform solution? And there are plenty of debates around that and why you should pick one over the other, but I would re-emphasize the point that there's nothing wrong with running a SMIC as long as you can meet the expectations.
Yeah, I mean, it's interesting that I guess those are essentially governance issues, and Rolfine, you mentioned at the beginning that this was possibly sort of the year of climate change, so I guess the E within the ESG, but are we likely to see more focus on the G within that acronym, particularly things like shareholder voting and pooled funds?
Yeah, I very much think so. I would say, let me first talk about DWS. So at DWS, we decided that climate change was a big issue and the defining issue of our time back in 2005. So we were very early. We built a climate research institute, published a lot of research on climate change and the impact on the investment landscape and for investors, both institutional investors and retail investors as well. We also aligned our voting, our proxy voting, with our very strong views around climate change also. So in other words, as if you really believe in the topic of climate change and you really want to create an impact as a fund manager or as an asset owner, the best way to do that is through the G in ESG, through either corporate engagement, engaging with the companies that you are invested in trying to influence these companies to build a strategy to go from a high carbon to a low carbon economy, from a high carbon to a low carbon company, through everything that company may be engaged, the business activities that company is engaged with. So a very strong focus on corporate engagement. DWS, for example, is also a member of Climate Action 100+, the asset manager, asset owner network that is working with the top 100+ polluting companies in the world to get them to a more sustainable path. So corporate engagement is absolutely key when it comes to advocating for climate change and change at the company level. But also important is the proxy voting through shareholder resolutions at annual shareholder meetings. And I think, although we have been an active manager with a active corporate governance practice since 1994, again, over the last 2 years, I would say, investors all over the world have woken up to the fact, maybe that's a strong wording, but have woken up to the fact that if they want to impact change, whether it's on climate change or on social issues, and clearly COVID-19 has really focused attention on a lot of social issues, but also on health and well-being issues. If you want to influence these strategies within companies and you want to influence company behavior, you can do that through your proxy voting process. So corporate governance has become a lot more important in ESG than it was 2 years ago, 4 years ago, 6 years ago, etc. I mean, a lot of times we think of activist hedge fund investors as the investors that change companies. No, actually, every investor can change a company through the proxy voting process. And so there's a lot more focus on it. And to your specific point around proxy voting into pooled funds, it's interesting to see the UK regulator starting to move into that direction and asking the industry, how can we create ownership of proxy voting at the investor level into a pooled fund? And that is definitely something that we at DWS are looking into.
And I think, Nick, the journey is interesting, right? Because if you go back a decade or more, a number of managers were looking at running Sharia funds, which focused on certain stocks and the dividends being paid away to charities, and then never quite took off in Europe. And then equally, Rolfing has referred to the activist hedge manager. Sometimes they were viewed as the troublemaker, right? Now it is all about the G, and I think when people think about ESG, everyone can talk about the E because it's readily identifiable: single-use plastic, climate change, carbon. It's in the parlance of our children who want the day off school to go and march in the city, right? Sometimes to provide the homework as opposed to express an opinion, but nonetheless, on the S part of ESG, I'm not sure that was talked about very much until we had the unfortunate passing of George Floyd. But Black Lives Matter really put the S part of ESG front and center with the world, right? And when you get to the G, I think the proxy voting agenda is really important because it's now not just being talked about from an investment manager perspective, as Rolfing is, but it's also being talked about from government. So even in the UK, Guy Operman, the Minister for Pensions and Financial Inclusion, he's looking at how proxy voting for pension schemes and the underlying members can be exacted and fed into how funds and positions perform. So I do see the power of the common person is going to start to feature in the G of ESG. So we've gone from just being E and mute on S and G to being really vocal on all three now. And I just think that journey has been quite interesting to observe.
And if I could add to that as well, the other piece that COVID-19 has really shown to the world is one, clearly the world wasn't ready, and maybe still isn't really ready to deal with the impact of COVID-19. And so that has brought to the attention in people's minds, if the world is not ready to deal with COVID-19, how about the impact of climate change? And then to Owen's point, the whole COVID-19 situation led to social unrest with the unfortunate death of George Floyd, but then created the Black Lives Matter movement, which is now gone global, and companies need to pay attention to that. But also COVID-19 has really brought to the forefront what are the health and well-being policies of companies. And so indeed, as shareholders and fund holders, you really can have an impact on all these issues that are important to you. And at DWS, I mentioned how long our history is in climate change, but we've always voted in favor of climate change resolution. So that means that, for example, in the US, our funds, 98% of the times that we vote for climate-related resolutions, we vote in favor, and that makes us the most aligned asset manager both in the US and in Europe when it comes to basically putting our money where our mouth is and really voting and trying to exact change. But it's also a fund manager's responsibility to engage with companies. As I mentioned earlier, proxy voting is one piece, but the other piece is engaging with companies and asking these questions. What are your health and well-being policies? What's your diversity policy? How are you dealing with independence of audit committees? How are you taking environmental issues into your business? So there's this wake-up call that you can really exact change, and we just have to look every single day. There are companies that are making commitments to net zero by 2050, companies that are pushing this through in their supply chain. I mean, every single day. Opened the FT this morning, ExxonMobil is now going to create more transparency on level 1 and level 2 emissions. We still need to work with ExxonMobil on level 3. emissions, but at least there is progress to be made. And so these are the things that investors can really influence, and it is through engagement and through proxy voting that we have a very big stick to make sure that change indeed happens.
Sure. I mean, I am conscious of the time, so we're sort of rapidly approaching the end. So one question I want to get in before the end is sort of on that point and the rise of ESG and more reporting and investors' demand for transparency. Obviously, there is a cost attached to this at the end of the day, even with improving the proxy voting process as well. So who do you think will ultimately bear that cost? Will there be an ESG premium on products, or is the demand for these kind of products so inexorable that it's asset managers that will ultimately have to bear that cost? So I don't know who wants to take that one first, but maybe sort of 30-second answer from everyone, and then we can
I can go first. I think there's a truism that costs generally go in one direction, and that's up. And it's how firms and the sector responds to that pressure is so I suppose more generally we're seeing, firms, I suppose one thing COVID has done is forced more firms to look at, their cost base, look at their automation, digitization. I think the initiative that Rolf mentioned earlier about ESG data, all those kind of things will help to try and reverse the inexorable rise of costs. And it's a case of, I suppose firms that can react quicker might have a competitive advantage over firms that are slower to react and therefore end up having a higher cost base.
Sorry. I was just going to say, it's my personal view that all investing will be ESG investing on a going forward basis. And it's also my view that ultimate clients are not going to pay a premium for something that becomes industry practice. So that is my own personal view in this particular matter.
So I think Rolfine is right, but I think it may take time to get there. So I think initially certain costs will be passed on if you're taking a particular index or you're using a particular voter, etc., that may end up going through the fund. I would welcome what Rolfine touched upon at the opening, which is the French and the Dutch regulators looking for coalescence in terms of definition of data, because the frank reality right now is the absence of harmonization means that to do the role properly, you have to take several streams of data, and that data isn't cheap. And the greater the harmonization, the cheaper the data. That may be bad for the data providers, but ultimately I think for the end investors who we actually care about, I think it's a good thing. So I think that's where it'll go, but it'll take a little bit of time.
Yeah. So we're almost at the end. So given that this is our last Funds Europe webinar of the year, and it's been quite a year, I just want to ask how optimistic everybody feels about all these challenges that we've raised and whether they can be addressed next year. So just a concluding remark, I guess. Yeah, so Rolfie, maybe we'll start with you.
Okay, yeah, thank you. I'm a born optimist, and for me, it's really all about ESG. And having seen the incredible momentum of ESG investing over the last year, I think that will continue. And to Owen's point, and what, for example, the French and the Dutch regulators are trying to do will hopefully ultimately end in a more fairer play for large and small asset managers, large and small asset owners. But I'm a born optimist, and I really look forward to 2021. I hope it will be more of a year of light than a year of darkness that we have experienced in 2020. And I hope that we have learned as human beings, but also as an industry, how resilient we ultimately are, both on an individual level and as well as on a company level and an industry level. And hopefully with more light in 2020, I'm optimistic for the future.
Thank you. And Ken?
Yeah, I mean, I'm naturally a little bit more skeptical, but I am optimistic. I'll give a plug. We PwC have just published a report on the future of financial services, and particularly a piece on the asset management industry. We think the industry is crucial It has the power to shape the future. I think it's tied into kind of the key, 3 fundamental priority areas facing the world of, funding the future, providing for the future, and embracing ESG, as Rolfing has mentioned. So I'd be very optimistic. We see a bright future for the industry.
And finally, Owen?
Yeah, if I ask my dad, is he a glass half full or glass half empty? He says there's a glass. So I'd very much be an optimist. I think Ken touched on this earlier. The industry is very innovative and very creative. And I think for all of the actors across asset and wealth management, be they auditors, lawyers, administrators, investment managers, etc., it's an arena of problem solvers that come together, and every year there's something different, right? Whether this year it was COVID-19, other years it was credit crisis. There's a great theater of politics, economics, socio-political, all interacting every year, and I think next year's show will be just as interesting.
Great. Well, thank you to my panelists for your time, Rolfing Kuipers, Ken Owens, and Owen Motherway. And thank you to all the audience questions. We got several in that we just didn't have time to get to, but what we can do, hopefully, is I will distribute them to all our participants, and maybe we can get back to you on that, or certainly subjects will follow up in the magazine next year. So again, thank you very much for your time, and have a happy New Year and a happy Christmas.
Thank you.
Same to everyone.
Happy Christmas, everybody.
Thank you. Bye.